Welcome to the lecture, Financial Accounting for ICB. My name is Ms. Akwenye. Please find my contact details 081 46 99 338. Please feel free to contact me for any question related to the subject. Let's look at activity number 1, Integration Task 3.1, page 79. You were asked to describe the qualitative characteristics in detail of financial statements. Let's look at the first one, understandability. What does it mean for financial statements to be understood, to be understandable? The financial statements must be understandable to the users thereof. So someone that's using or pursuing the financial statements should be able to understand them. However, it is implicitly assumed that the user has a reasonable knowledge of accounting and willingness to study the financial information diligently and comprehensively. The second one, the financial statements should be relevant. They should be relevant. There should be a level of relevance in them. What does it mean for financial statements to be relevant? When deciding what is relevant, one must consider the user's needs in decision making as well as the materiality of the items. Materiality is a term that is very important for every prospective accountant to understand. It basically means that all material items of significance, must be recorded by the accountant. An item could be an actual transaction or the choice of a value to be assigned to a transaction. The accounting framework suggests that you should consider something, an amount, or some other information to be material if the economic decision of the stakeholders could be influenced if they were misstated or omitted. Reliability. Financial statements should be reliable. What does it mean for financial statements to be reliable? In order for financial statements to be considered reliable, they should not include material error or bias and should be a fair representation of financial performance and position. Financial statements need to be neutral, prudent, and complete. Comparability. Financial statements need to be comparable. Financial statements must be comparable from one year to the next. Therefore, accounting policies must be consistently applied. This means that similar transactions should be treated in a similar fashion and in the same way they were treated in previous years. An example of this, financial statements must also be comparable from one entity to the next. In order for this to be achieved, accounting policies must be consistent. For example, assume a 20% straight line depreciation rate is applied in 1 year. The same method, the same depreciation of straight line that you used, the same method and rate, the 20%, needs to be applied in the subsequent year. So in 2008, if we use the straight line at 20% to depreciate our asset, that's the same rate that you are going to use and the same method, the straight line, that you are going to use for 2009. Unless there has been a change in policy, in which case it should be clearly communicated to shareholders. Activity number 2, page 3 to 4. You were required to calculate the current assets as at 31st January 20.8. You were supposed to also calculate the non-current assets for 31st January 28. The current liabilities, the non-current liabilities, the profit for the year, and also your owner's equity amount using both the accounting equation method and the equity accounts method. Let's now start calculating our current assets. The current assets amount, it's 31,950 plus 85,200, which will give you a total amount of 117,000 dollars. Then you will need to calculate the non-current assets. 426,000 plus 106,500 plus 225,600 plus 68,160 equals to $856,260. So that is your non-current assets. The amount for your current liabilities is 34,080 plus 4,260, which gives you a total amount for your current liabilities of 38,340. The non-current liabilities is only 170,400. To calculate our profit for the year ended January 20.8, you have your sales column and your income column. Our first entry, you have sales, which is an income of 639,000. Then you have the cost of sales, which is an expense. It's the amount of money that we spend to purchase our sales, which is 298,200. Then you have your rent income, which is 52,560. Then you have your interest on loan, 7,040. Settlement discount received, which is an income of 14,910. Your settlement discount granted, 10,650. Water and electricity expense, 8,520. Our wages, 6,390. General expenses, 38,340. In total, our expenses were 379,140.00. Our total income was 679,470.00. Moving on to method number 1 to calculate our owner's equity amount. We'll use the first method, which is our accounting equation method. Your owner's equity equals to your assets minus liabilities when we use our accounting equation. Our total assets we have calculated in 1 and 2. Number 1 and 2, we calculated our current assets and non-current assets. So it's 117.50 plus 856,260. That's the total for our assets, because the assets include your current assets and your non-current assets, less your liabilities. Your liabilities also in this case include your current liabilities plus your non-current liabilities, and we have calculated this in the previous slides. 38,340 plus 170,400 is your total liabilities. That gives you a total amount of 764,670, which is your owner's equity. Using method 2 to calculate your owner's equity, we say your capital is 506,940 plus your net profit of 333 less the drawings that were made of 42,600 will give you a net profit or your owner's equity of 764.670. Note at this point that your owner's equity amount calculated using the equity accounts and the one calculated using the accounting equation are the same. Let's move on to activity number 3. With activity number 3, you were required or you were asked to calculate the gross profits for software and hardware. Let's look at the sales for hardware. It was $657,850. The sales for their software was $300,000. The total for the sales for both hardware and software was $970,150. Now we say less our cost of sales, which is $546,200 for hardware and $30,200 for software. In total, the total cost of sales is $870,600. We have calculated our cost of sales by adding our opening inventory of $120,000 plus our purchases for the current year plus our carriage on purchases. If you add all the amounts in gray, you will get the cost of sales. To get the gross profit, we say your sales of $657,850 for hardware less the cost of sales for hardware of $546,200 equals to your gross profit of $111,650. The same for software. We calculate the gross profit by saying sales for software is $312,300 less the cost of sales for your software was $30,200. The gross profit in that case will be $342,500. That's the end of the lecture. Good luck with your exam.